Ever wondered how countries manage when they run out of money? It's not like they can just pop down to the cosmic ATM and withdraw a few billion galactic credits. Instead, they often turn to an institution that sounds like it was named by a committee of economists who really love acronyms, the International Monetary Fund, or IMF. Today, we're diving into the IMF, an organization that plays a crucial role in the global economy, often acting as a lender of last resort for countries facing financial turmoil. But like that one friend who lends you money but then insists on knowing what you spent it on, the IMF doesn't just hand out cash without some strings attached. So buckle up as we explore the IMF's operations, funding, and the countries that have relied on its loans the most. We'll try to make it as painless as possible, like a root canal, performed by a dentist, who also happens to be a really good stand-up comedian. The IMF, born in the aftermath of World War II, was designed to be a sort of global financial firefighter, ready to extinguish economic blazes wherever they might erupt. Its mission to promote international monetary cooperation and exchange rate stability, facilitate the balanced growth of international trade, and provide resources to member countries experiencing balance of payments difficulties. Think of it as a financial therapist for struggling economies, offering not just a shoulder to cry on, but also some very large loans. The IMF operates like a massive credit union, with 190 member countries pooling their resources to create a giant financial safety net. When a country finds itself in dire straits, facing a currency crisis or struggling to repay its debts, it can turn to the IMF for a lifeline. But like any good therapist, the IMF doesn't just hand over cash and wish you luck. It comes with conditions, often demanding structural reforms, fiscal austerity measures, and increased transparency in return for its assistance. These conditions, often referred to as structural adjustment programs, can be controversial, with critics arguing they impose harsh burdens on already struggling nations. It's a bit like going to a doctor for a broken leg, and being told you also need to give up sugar, start jogging, and learn to knit as part of your recovery plan. Now you might be wondering, why would any country subject itself to such stringent conditions? Well, when you're facing a full-blown economic meltdown, desperate times call for desperate measures. The IMF's loans, even with their attached conditions, can provide a crucial breathing space, allowing countries to stabilize their economies, restore investor confidence, and prevent a full-blown financial collapse. Imagine a country teetering on the edge of a financial precipice, its currency plummeting, its debts mounting, and its citizens facing economic hardship. The IMF, with its vast resources and expertise, steps in like a financial superhero, offering a lifeline in the form of emergency loans and policy guidance. It's not always a perfect solution, and the medicine can be bitter, but it can help prevent a bad situation from spiraling into a complete catastrophe. So where does the IMF get the billions of dollars it lends out to struggling nations? Well, think of it like a giant potluck, where each member country contributes based on its economic size and standing. The more economic firepower a country has, the larger its contribution to the IMF's coffers. These contributions, known as quotas, form the bedrock of the IMF's lending capacity. But the IMF's funding sources don't stop there. It also has access to borrowed resources, like a line of credit from its member countries, which it can tap into during times of heightened demand. Imagine the IMF as a homeowner with a large savings account, but also a credit card for emergencies. The quotas are the savings, providing a stable base of funding, while the borrowed resources act as a credit line, allowing the IMF to respond to unexpected crises. The IMF also earns income from the interest and charges it levies on its loans. It's like a bank charging interest on its mortgages, except the IMF's clients are entire countries, and the stakes are considerably higher. This income helps replenish the IMF's resources, ensuring it can continue providing financial assistance to its members. Beyond its core lending operations, the IMF also plays a crucial role in global economic surveillance, monitoring economic and financial developments in its member countries, and providing policy advice. It's like having a team of economic detectives constantly on the lookout for signs of trouble, analyzing data, identifying risks, and recommending preventive measures. Think of the IMF as a global financial watchdog, keeping a close eye on the economic health of its member countries. It analyzes economic data, assesses risks, and offers policy recommendations, aiming to prevent crises before they erupt. It's like a financial early warning system, trying to identify potential economic storms before they make landfall. Now let's take a look at the countries that have borrowed the most from the IMF, a list that reads like a who's who of nations grappling with economic challenges. At the top of the list sits Argentina, a country with a history of economic turbulence and recurring debt crises. Argentina's relationship with the IMF is a complex saga marked by repeated borrowing, stringent austerity measures, and occasional backsliding. Next up is Egypt, a nation grappling with high poverty rates, a large informal economy, and a reliance on tourism, a sector vulnerable to global shocks. Egypt has turned to the IMF for support in recent years, seeking to stabilize its economy, attract foreign investment, and promote sustainable growth. Third on the list is Ukraine, a country facing a unique set of economic challenges stemming from its ongoing conflict with Russia. The war has devastated Ukraine's economy, disrupted its infrastructure, and displaced millions of its citizens. The IMF has stepped in to provide emergency funding, helping Ukraine keep its government afloat and meet its essential spending needs. Pakistan, a country facing high poverty rates, political instability, and a vulnerability to climate change, also ranks high on the list of IMF borrowers. Pakistan has a long history of borrowing from the IMF, seeking to address its fiscal imbalances, promote economic growth, and improve its social safety net. Rounding out the top 5 is Greece, a country synonymous with the Eurozone debt crisis. Greece's economic woes, rooted in high public debt, unsustainable spending, and a loss of competitiveness, led to a series of bailouts from the IMF and its European partners. The Greek crisis highlighted the interconnectedness of the global economy and the potential consequences of fiscal imprudence. These top borrowers represent a diverse range of economic circumstances, highlighting the IMF's role as a global lender of last resort. Their stories underscore the complexities of economic management, the challenges of navigating financial crises, and the role of international institutions in providing support and guidance. So, there you have it, a glimpse into the world of the IMF, an institution both praised and criticized for its role in the global economy. We've explored its purpose, its funding mechanisms, and the countries that have relied on its loans the most. The IMF, with its vast resources and expertise, plays a vital role in promoting global financial stability, providing emergency funding to struggling nations, and offering policy guidance. But its approach, often characterized by stringent conditions and austerity measures, has also drawn criticism, with some arguing it imposes undue burdens on already vulnerable populations. The IMF's role in the global economy is complex and multifaceted, prompting debates about the balance between financial assistance and national sovereignty, the effectiveness of its policy prescriptions, and the long-term consequences of its interventions. The IMF's impact on global financial stability is undeniable, but its methods and effectiveness remain subjects of ongoing debate. For more insights into global economics, don't forget to like, subscribe, and hit that notification bell.